Equities are still getting pummeled. Russell down the most right now, but tech has been drifting lower as well. Do we blame the Fed, though? Danielle DiMartino Booth joins us this afternoon. Of course, a great day to have her. CEO and Chief Strategist at QI Research. Danielle, great to see you.
Great to be here. Thanks for having me on this Fed day.
I kind of started, appreciate that. I appreciate you being here. I kind of start off our show with a little bit of a rant. My point was that if you were surprised by this in any way, if you have to sell stocks today because of what we heard from Jerome Powell, then you might not be doing it right. What do you think?
I think the Fed right now sounds like they're pretty out of touch with the rest of the United States.
Yeah.
It sounds like they're making policy based on the fact that the top 1%, those who own Nvidia, those who own Bitcoin, that they're doing just fine. They completely have lost touch with the fact that if you are out of work, you're out of work for a median duration of 10.5 weeks. That's the longest since, I guess, October of 2008. We were 9 months, 10 months, 11 months into recession at that point. So I think the Fed's going to be eating its words when it comes to backing down, because things are not as swimmingly well in the labor market as Chair Powell painted a picture of today.
What will we measure that by? Because, of course, over the last year and a half, I've heard some of that before, but inflation's come down. GDP's hitting 3%. To the point of jobs, they have weakened. Unemployment's risen. But nominally, I don't think anybody would ever look at this without knowing what's going on and go, oh, things are terrible.
Yep, no, and you're absolutely right. But what was curious to me, when you've got a November unemployment rate of 4.426, 4.246, let me be correct here, and the Fed is saying that the unemployment rate is going to end the year at 4.2. In other words, that the labor market's going to improve from November to December. I find that to be very, very curious. I completely understand that your average investor is going to key purely off of headlines, but we forget that in the first quarter of 2001 and the first quarter of 2008, these were the first full quarters of recession that we didn't find out about it for 5 full quarters. And that's, again, why I think to a certain extent the Fed is being tone deaf to your average working woman and your average working man and listening solely kind of to the potential risk of tariffs and the world that investors live in.
Where do you get that jump, though, into who's the inputs? Because when he says data dependent and real rates right now are by pretty much every definition restrictive, like I hear you, I look around, look, I'm like the biggest Bitcoin cynic in the world, all right? And the things at like 110, that to me seems absurd. But I still look at the inputs that he's told me that he's going to go off. Inflation's come down and unemployment has crept up a little bit. It seems like if he's trying to right the ship by the average person and he's responding to unemployment by cutting, how come that's favoring the rich?
Well, he's barely cutting, though, and they've cut their projections in half for 2025. We woke up this morning thinking that the Fed might validate the prior dot plot, and instead they cut the potential for rate cuts in 2025 by 50%. They went from 4 rate cuts in 2025 to 2.
You think they should be going heavy right now? You think they should be doing like 50?
No, it's not so much that I think that they should be doing 50. I think that they should be mindful of the fact that unemployment has continued to tick up. If they want to split hairs, they can say that it's 4.2% if you round it down. But for the average working American, I really don't think they care. But that's why we've seen continuing jobless claims rise to the highest level since November of 2021 and stay stubbornly up there. So you can't try again and thread this needle, but I think it's very insulting to individuals who are feeling the pinch of a much, much looser jobs market than what we had, including the fact that we're seeing shelter inflation come down fairly rapidly.
Okay, I see the point. Here's then the counterpoint I would offer is then doesn't he deserve credit, though, for starting off with 50 when the market thought he only needed to do 25? I mean, it was close, but he still got us off with a bit of a bigger swing than the market was looking for. So, I mean, he's gone a little bit more than what the market has asked for in the last 6 months.
Without a doubt. And at the September meeting, he basically alluded to the fact, you know what, we should have started lowering rates in July. Don't look too far into this. The only thing we're doing is playing catch up with what we should have done in July, in September, by delivering that belated July rate cut right now by starting off with 50. At the September meeting, he also mentioned the massively large revisions that we've seen to payrolls. He didn't make mention of those revisions this time around. And in fact, despite the fact that they've gotten even larger since then. And the Philadelphia Fed, I can guarantee you, made a presentation that said that according to Bureau of Labor Statistics data, it looks like job destruction began in the second quarter of 2024. He's dissing a lot of his own internal research and a lot of the official data that's out there because the revisions have just gotten worse since that September meeting, and he's pretending like happy days are here again.
How do you read the inflation data? Because, of course, last few readings have warmed up a little bit, so one could argue that he is being data dependent and maybe even bold cutting with PCE coming out in 2 days. Who knows, right? Because if it comes out warm, people are going to then come on my show and be like, this guy's an idiot for cutting at all. But is he not leaving himself some optionality here, Danielle, with still saying, hey, we can give you 2 cuts and, you know, appreciate that some of this inflation has stuck around? Or do you think the inflation data are actually much more deflationary than what we see in the reported figures?
I think that the irony is that it was the Cleveland Fed president who decided to dissent. She's a rookie. I mean, good for her for saying what she feels. But it's specifically the Cleveland Fed's inflation research that shows that the shelter inflation input to the CPI in 2025 is going to fall from whatever it is right now, about 4.6% to 2%. That's also what other on-the-ground apartment REITs are reporting, and that is that apartment rents have actually begun to decline. We're seeing the same rise in housing inventories, skipping past in many large states and municipalities where they were in 2019, which is indicative, supply-demand and the way it works, that housing inflation is also going to be coming down. I think the greater risk, once we get past some base effects in the next few inflation prints, I think the greater risk in 2025 is that the Fed finds itself backpedaling. Okay, and in that direction, that kind of comes back to the question before, where do you see that playing out? You see that as them backpedaling and saying, okay, actually, we should have been much more aggressive. We got to do 50 bips type stuff again. You're more, it seems like, in the recessionary, deflationary camp. It's not me that's in the camp, it's the data that's in the camp, and it's the data that's already telling us what's in front of us, as well as the fact that Indeed job postings, every metric that you can throw out there is showing that the job market is continuing to weaken. I don't necessarily think that they throw unusually large rate cuts at us come January or March, but I do think that when we see the next dot plot, that we may see the projections going from, okay, we went from 4 to 2, maybe we're going to go back to 3 or 4 for 2025. It's not a good look for the Fed. You want to see a little bit more consistency in monetary policy making, and today it was very apparent that he wanted to throw every single option out there that he possibly could. It was as if we were seeing an economist with not 2 but 3 hands.
Hey, it's been a confusing, tough couple of years. I feel like the cumulative economist view, if you measure like Bloomberg or whatever, I mean, there was an article there, what point was it last year, where 100% probability of recession. So I think he still is doing better than the average economist. Danielle, to the last point, though, we got a couple charts. 2 tracks of the economy, real retail sales versus industrial production. I thought this was an interesting chart from one of your reports. Take me through that real quick.
So it's really interesting when you look at retail sales and you see where the strength is, and when you listen to people on the ground, they're telling you that the wealthy are still spending on luxury travel, that they're still spending this holiday season. And on top of that, you're hearing from households who are tapping into buy now, pay later, which is expected to cross $100 billion in early 2025, that people are tapping their credit cards, tapping buy now, pay later, doing whatever they possibly can to continue spending, whether they can afford it or not, while the industrial recession in the United States continues to deepen. And it really is a 2-track economy of sorts. But you have to ask yourself, with individuals for the first time being being reported to credit reporting agencies after not having paid their student loans since March of 2020, starting in just a few weeks in January, you have to wonder where retail spending is going from here, especially if we continue to see the stock market correct.
Okay. I think it's a pretty compelling point. The last one there about the timing for loans. Then I guess you could also argue, hey, like these are different parts of the economy. You can get a gap between industrial production and sales. But I like the discussion. I love the analysis. Thanks a lot, Danielle. Appreciate you being here.
Thank you very much. Happy holidays.
Absolutely. Likewise to you as well. Always appreciate the commentary. Danielle DiMartino Booth, CEO and Chief Strategist for QI Research. There we go.